Good morning. Happy lunchtime for folks on the Central and East Coast. Welcome. Thank you for joining on this webinar Wednesday. We've got about 80 folks joining. Let's get some chatter going in the chat box. Tell me something good that's happened today. It could be small. You didn't have to share your Uber to work. You made your coffee just right. Where y'all calling from? Got a new client, Matt. Congratulations. Asia's drinking turmeric ginger latte. That sounds so healthy and so delicious. What else we got? Hi from Michigan. Hi from Portland, Maine. Welcome, welcome. Mark from Philly. It's not raining in Kansas today. I'm happy for you, Tammy. Brian made a great cup of coffee. I love it. Karen, a hurricane missed you in Hawaii. That is a blessing. Welcome. Thank you for joining. Arbonne Clean Energy Fizz. I like this prompt. This is just like feel good. Parking ticket got dismissed. That is a huge win. I'm in San Francisco and I can tell you the parking tickets are a pain point for me in my life. Congratulations. Paige, weather in Tennessee is looking good, looking like fall, feeling like fall. That's great. Jason, founder, single employee, would you recommend ADP for paychecks for payroll? Great question, Jason. So welcome everybody. Today, this is a session where we're gonna walk through a couple short slides, and then we're gonna pivot over to the AMA section. So Jason, if you don't mind pulling up the Q&A box in Zoom and dropping that question in there, and we'll definitely get to it. Same goes for any questions that this group has throughout the course of the webinar. Today, we're focusing on S Corp specifically, and really from the lens of a small business or self-employed business owner. So just a little asterisk, taxes can get complicated. So if your tax profile is a bit more sophisticated than a solo-owned business, this course or this session may not cover the scope of what you need, but we're going to keep it simple. We're going to keep it focused on self-employed businesses of one. Welcome, everybody. Thank you for the chatter. Kay had some easy traffic. Love that. We're going to dive in. Questions in the Q&A box, if you don't mind. Keep the chatter open, and we're going to dive in. Welcome. So today, this session, we're going to spend the first 10 minutes just really quickly getting through this short agenda. What is an S Corp and why do they exist? The power savings of S Corp. How does the math work out? When it makes sense to consider an LLC versus adding the S Corp election, and then we'll move over to the Q&A. I'll leave this disclaimer up for just a quick second. This webinar is for educational purposes only. Quick about me, I've been with Collective almost 4 years, which is a long time in startup world. And before that, I was a tax accountant in public accounting. So 8+ years through the trenches working on business tax returns of all shapes and sizes, which has led me to this opportunity here to speak with you all. So we're going to dive in. What is an S Corp and why does it exist? So a little bit of foundation. When you form a business, there's actually two parts to it. One is your legal status and the other is the tax status. When you go to form a business, you may go to your state's Secretary of State website and you'll choose a legal structure, a legal entity structure. So this is this legal status here on the left. The legal status can be an LLC, a professional LLC, a legal corporation, or a stock corporation. And these are what give you a tax ID. It's what gives you the legal business name. It creates a layer of liability protection. So it's separating your personal assets from your business assets. And this is the legal structure established at the state level. Next, you have to consider what's your tax status. So the tax status is how you file and report and ultimately pay your tax on that business income. So tax statuses, many of you might be a sole proprietor, which is considered a disregarded entity for tax purposes. What that means is that Whether you formed a single member LLC or not, for tax reporting, your business activity may just go on your personal tax return. It's called Form Schedule C. Maybe you filled it out before. It basically summarizes your profit and loss. And this is called a disregarded entity because in the eyes of the IRS, you and your business are one taxable unit, which is why that business activity gets reported and lumped into your personal tax return. So that is a type of tax status. Maybe you're in that now. Another tax status, which is what we're talking about, is the S Corp tax election is considered a tax status. Once you make that election, it actually gets layered on top of a legal structure. So maybe you have a single member LLC, and then you add the S Corp election tax status. What that election does is tells the IRS, we're going to start reporting this business activity on a separate business tax return. And so when you're forming a business and maybe somebody says, I have an S Corp, it's actually a two-part formation process. One, you establish a legal entity first. So this could be your LLC. And then you add the S Corp election to indicate your tax status. So that's kind of some foundation of how is an S Corp formed? Why does it exist? The S Corp election comes from a particular section of the tax code, subchapter S, that was created to combat that traditional C Corp double taxation structure where there's a corporate level tax. The S Corp status was created to encourage the growth of small business. So without it, and maybe this is where you're at now, you pay multiple or different layers of tax on business income. What the S Corp election lets you do, in short, is give you an opportunity to reduce self-employment tax. So the S Corp election exists. It's part of the tax code. It was created to encourage the growth of small business. I'm just taking a quick look at the chat. If you have a question that you put in the webinar chat, please copy and paste it to the Q&A so that I make sure I don't miss it. So the power of S Corps, how the savings actually work. So we're going to talk some high-level maths here and some foundations. How do you pay taxes when you're a solopreneur or self-employed business? There's two types of taxes. One is income tax. This is the unavoidable tax that all of us US citizens and residents, we can't escape. We're going to pay income tax if you have taxable income from any source. So your business, if you got stock investments, maybe your spouse has wages from their employer, all of that is subject to income tax. Income tax, this is what you file every April 15th. It reports your total household income based on your filing status. So single, married, filing, joint, head of household. And then you combine all of that household income to ultimately determine your income tax. So that's one piece of it. Income tax is determined at the federal level, so with the IRS. And then depending on what state you live in, you'll also have a state level income tax. Then separately, you'll have self-employment tax. So for those of us who are sole proprietors, single member LLCs, maybe you have an S Corp already. When you're self-employed, you also have self-employment tax, which is made up of 2.9% Medicare tax, and then 12.4%, the majority, is Social Security tax. So if maybe you're somebody who hasn't started your self-employed business, maybe you're still in that corporate role, if you were to look at your pay stub, you'll see withholdings for Medicare and Social Security. And under a normal like employer-employee relationship, your employer will pay half of that 15.3% burden, and then you as the employee will pay the other half, which is what shows up on those withholdings on a pay stub. When you're self-employed, you are both your own employee and your own employer. You wear both hats, which means you pay the full burden, 15.3% on your business profit. So what's happening when you're self-employed is you're getting hit with multiple layers of tax, potentially on the entirety of your income. And so this is where, the issue is with these huge tax bills. So we're going to walk through a quick, very high level example of two instances, same business owner with different tax statuses. Here on the left, we've got someone who's set up as a single member LLC or sole proprietor, which means their business income is reported on their personal return, versus that same business electing S Corp status. So this business has 60,000 of profit. So profit is what's left over after all the deductions. Revenue is what you bill. Gross income, it's what you bill, money in from your clients. Then deductions, write-offs, expenses, those are all the same thing. You deduct those from your income, and what's left over is business profit. And this is the number we're interested in because this is what's ultimately taxed. So in this instance, you've got 160,000 of business profit. Here on the left, the person taxed as a disregarded entity, so Schedule C filer. That entire 160 of profit will be subject to the 15.3% self-employment tax. So that's yielding almost $25,000 in self-employment tax alone. It's not considering income tax. Under the S Corp election, what are the logistics? How do the savings work? The S Corp election, once you add that tax status, it triggers a lot more compliance requirements with the IRS, one of which is maintaining more comprehensive financial statements. You have to file a separate annual business tax return each year. And then this is the key component. Once you elect S Corp status, you have to pay yourself what's called a reasonable salary. Then under this structure, the reasonable salary only is subject to that 15.3% self-employment tax instead of the entirety of your profit. So what the S Corp election allows you to do via payroll is carve out a smaller portion to pay self-employment tax on. Everything else is the same. Whatever's deductible for you now continues to be a deduction as an S Corp. It's really the ability, the requirement to one, pay yourself a salary, and then that gives you the ability to control and potentially reduce the self-employment tax. So in this example, same 160 of business profit, but this person has paid themselves a reasonable salary of 60,000. What does that mean? Only this 60,000 rather than the 160 is now subject to self-employment tax, which is, 24,000 versus 9,000, a reduction in self-employment tax of nearly $15,000. So that's the advantage. That's what the S Corp unlocks, but with it comes a lot more complexity and compliance and filing requirements. So when do either structures make sense? We're going to compare like a single member LLC or sole proprietorship versus S Corp election. Generally, folks are looking for a savings opportunity, and that's what the S Corp can potentially unlock, though it's not the only reason to elect S Corp status. But high level, an LLC, single member LLC, could be best if your business profit is under a certain threshold. We like to use 60,000. That's the point at which the savings potential of an S Corp is more than the cost of a collective membership. So really what you're factoring in is if you're looking for savings, you want to consider that your savings potential is more than the cost to do the extra work. So whether it's collective or DIYing or using a CPA, you want to consider that your costs are less than your savings opportunity if you're looking for savings. So $60,000 of profit is a generic threshold. It's not a rule with the IRS. It's just where do the savings exceed the cost of a collective subscription to do the maintenance. An LLC may be best if you also have or are earning additional income on another role. So because an S Corp election helps control and reduce self-employment tax, if you earn money outside of your own self-employed business, that income is also subject to Social Security and Medicare tax, which can limit or reduce the savings potential of an S Corp. An LLC may be best for you if savings are not part of the picture because you have low profit or because you have a high earning salary elsewhere. Staying a single member LLC will keep your tax profile relatively simple, meaning you won't trigger the need for a separate business tax return or a need for payroll. So maybe you want to keep a simple setup. Maybe you're testing the theory with self-employment. Maybe you organically got a contract and you're just seeing if you like it. So you're not fully committed to self-employment full-time. Once you add the S Corp election, it does trigger an annual business tax return. So if you're testing the theory, you're not, committed to growing a business, maybe it's a one-off instance of a contract, it may not make sense to go set up this whole compliance annual tax reporting system if it's not going to be ongoing. The last piece, maybe you live in a state where S Corps are more expensive. I'm going to call out, and this is no hate, but if you live within New York City in the 5 boroughs, there's an extra layer of tax at the city level when you exist as an S Corp. And so that can negate some of the savings potential. When does an S Corp make sense? I will just reiterate here that the IRS does not have a rule about how much you have to make to be an S Corp. You can have a loss, you can have, any amount of business income and operate as an S Corp. So these thresholds, $60,000, are kind of just a vague benchmark of when the savings potential exists. So if your profit is over 60,000 from your self-employed business, that could be an indicator to have the conversation. If you want to reduce your self-employment tax bill, maybe business is growing, maybe you've proved the concept of your self-employed business and you've got huge growth goals. Maybe you want to put yourself on salary. So one of the benefits that are not related to savings, maybe some of you have been self-employed for a long time and have tried getting a home loan, and maybe it's been hard for proof of income. Putting yourself on salary, which is required of an S Corp, will give you pay stubs, and having a separate business tax return may help in the lending process if you're trying to get an investment property or a new house. And then maybe you live in a state with favorable S Corp tax treatment or low costs. I'm in California. We've got an $800 annual fee. It's deductible for your business. There's a 1.5% corporate level tax for S Corps in California versus New York City's almost 9%. So where you live can factor into whether or not the S Corp is a good direction for you. And we're going to pause real quick. I'm going to have my colleague Sarah pull up a quick poll. We've got 2 for you today. The second one will be once you leave the webinar. We just want to see what, get some general feedback. How can we make these better, more informative, more pointed to what is topical for you? So we're going to do 2 polls. We'll leave this one up for a quick second. And then we're going to dive into Q&A. I see 19 questions in the Q&A. And if you've posted one in the chat, kindly move it to the Q&A. We've got 10 minutes left scheduled, but we can go over. So if you've got a question, feel free to put them in. We'll give it another second for the poll. And then we'll get moving. Now, if you've completed your poll, and you're interested in booking a call with Collective, what does Collective do? Collective is a platform built specifically for solopreneurs who want to elect the S Corp status. So if you're not sure if it's the right time for you or you want to explore what it means to have an S Corp, the idea behind Collective is that if an S Corp is the right fit for you, we will support you in doing everything you need to either create your LLC and S Corp election and then maintain it. So included in our monthly fee is monthly bookkeeping. We set you up on Gusto, and that's the means to run your reasonable salary for payroll. We prepare and file your business tax return. And then on the front end, if you need us to set up an LLC for you, we can do that too. So this QR code, if you want to book a call with one of our advisors, feel free to scan it, jot down this promo code, fall50. It's your first month of Collective fees at 50% off. And Sarah's also going to post the links to schedule in the chat. And we're going to move on to Q&A. So I'm going to stop sharing my screen and pull up your questions. And we're going to dive in. Keep the questions coming. If we don't have time or you have to drop, we're going to record an overflow session of these questions and answers. So stay tuned. This video will be posted on YouTube. You'll also get an email after the session with a recording. And we're going to dive in. Nicole, I've got your question first. When should you transition into an S Corp? Is there a revenue number or threshold? So really what we're looking for is profit. So revenue is what you bill your clients. That's just money in. We want to consider all your deductions, all your write-offs, and what's left over as business profit. Generally, if your profit is over 60,000, again, this is not an IRS rule. It's an arbitrary benchmark to start having the conversation. If your profit is over 60,000 and you're not earning, like maybe you don't have a salary on the side, it's a good time to start having the conversation about S Corp. Now, whether you make income separately, whether your business activity is like, self-employment income or investment income, that can factor into whether or not an S Corp makes sense. But if it's a service-based business and your profit is over 60,000, Nicole, it's a good time to start having a conversation. Jason, thank you for moving your question. Any thoughts on ADP or paychecks? We use Gusto. We partner with Gusto. We have since the beginning of Collective. Gusto, if you use it as a standalone product, it's very intuitive. It's really built for the solopreneur in mind. ADP and paychecks are great, well-established payroll companies. I've typically seen them for bigger companies with a lot more employees. So depending on how big your business is, frankly, any of these options would be okay. We like Gusto because it's built for simplicity, with a solo business owner in mind. Kim, we haven't filed our 2024 LLC taxes. Can we retro as an S Corp? Also, can we still file 2025 as an S Corp? So for 2024, Kim, if you were to have elected S Corp status for 2024, an S Corp tax return would have been due already on March 15th of this year. And the extended deadline is in 5 days. So you can technically backdate an S Corp election. You would be behind on filings, which can have implications on your personal tax return. So you would consider, okay, what are the costs to get me caught up on compliance? And will those costs cancel out any savings advantage if I were to go back that far? So that's something to consider for 2024. Technically, the IRS allows you to backdate. Getting the catch-up compliance, you need books, you may need a catch-up payroll for the 2024 tax year, and to file a separate business tax return and possibly amend your 2024 personal return. So there would be a lot of costs and work, and finding an accountant that has capacity to do that, technically possible with the IRS to go to 2024. For 2025, when you're in the current tax year, it's a little bit more feasible. The tax returns aren't due yet. There's still time to run some catch-up payroll. You would have to rebuild the books if they're not established already. So the IRS does allow you to go back 3 years if you have an eligible business entity. So assuming your LLC was in place, it's just a lot of catch-up work. So you want to kind of outweigh the costs when you're considering going back that far. Vikram is testing the feature. Thank you. Okay, let's see. Vikram's got a big question. I currently have an LLC created with a partner to operate a fitness studio. You're the majority owner, 80-20 split, and you're paying yourself a salary of 80,000 gross. Is this the best way to put myself on payroll and do S Corp or write into an operating agreement? Okay, so I'll just level with you, Vikram. This is a little bit beyond the scope of what Collective is built for. We're built for solo-owned or single-owned businesses. So what you're describing here has entered partnership territory, which can get a lot more complex really quickly. Generally, I can say a partnership can elect S Corp status. And once you elect S Corp status, that does unlock the ability to pay both yourself and the business partner as a salary, like a true wage. But I may defer that question and point you in the direction of a CPA, because partnerships can get a little bit more nuanced, especially with the operating agreement. Asia, can I make my tax status an S Corp right now in September, or do I have to wait until a new year begins? No. So what do you need first before you can elect S Corp status? You do need a legal structure in place. So this could be a single member LLC, PLLC if you've got a professional license, but a legal structure does need to be formed first. If you don't have one right now, Asia, let's say you're a sole proprietor. If you don't have an LLC, the earliest you can elect S Corp status is that new LLC's formation date. And so if you need to form an LLC today, September 10th, the earliest, and it gets approved today, the earliest you can have an S Corp is today, September 10th. If you had an LLC that existed prior to 2025 starting, a timely S Corp election would have been due March 15th, but the IRS has a late relief process. So assuming your LLC was in place, you may be able to elect, make a late S Corp election following the late relief process. So what goes with that? You will have to rebuild books. You will have to consider reasonable salary requirements and potentially getting caught up on payroll. But it's not too late. You can follow the late relief process. It's something that Collective may be able to help you with. And you may be able to capture S Corp savings for this year. Let's see, anonymous attendee. So I applied for an S Corp several months ago before I understood what it really was. I found out a couple of weeks ago it was approved, but we are not even cash flow positive, so you can't take a salary. I don't know if I should keep it as is and hope the money starts coming in, or is there a way to cancel it? Okay, so maybe a premature S Corp election. So just to ease your mind, it's not an issue with the IRS that you have a loss. You can exist as an S Corp without a loss. Really, this reasonable salary requirement only comes into play if you as the owner are taking owner distributions, meaning you're taking money out of the business for personal use. So when you take an owner distribution, this is a little bit more context. When you take an owner distribution, it's a transfer from business checking to personal for the owner to use that money for personal expenses. When you take money out as a distribution without also taking a reasonable salary from an S Corp, it can look to the IRS like tax avoidance because a distribution does not have the Social Security and Medicare assessed. So they have this requirement to pay yourself a reasonable salary. So they have a means to collect on Social Security and Medicare taxes. So anonymous attendee, if you don't have profit yet and you're not taking distributions, it doesn't necessarily trigger the requirement for you to pay yourself a salary. In which case, you can still run your S Corp. You will have operating costs. Maybe you need bookkeeping. Maybe you don't necessarily need the payroll part right now if you're not taking distributions, but your filing requirement will still exist. You can revoke an S Corp election, but the IRS does prohibit you from re-electing on that same entity for 5 years. So if year one is just not it, it's like the beginning, but year two, you've got some growth goals and potential clients coming up, it may make sense to keep it open and just know that maybe your operating costs for this initial year may outweigh any savings potential that the S Corp may give you. But if you're going to keep growing the business, it's going to stay open. I wouldn't necessarily revoke the election because it prevents you from re-electing. We are at time. But you've got great questions. There's 36 more. They're coming in. Thank you. Hang on if you can. We've got 130 people still here. We're going to keep recording. We'll stay on for maybe another 10 minutes, and then we'll record answers to the rest. So thank you so much, the engagement. Super appreciate that. We're going to keep going with Bart's question. When I signed up for info from Collective, they said being in California, it might disqualify me. Is that true? So Bart, we disqualify certain businesses that in California if you have a professional license. And that's because in California, a professional licensed individual needs to form a legal structure of a particular type. It's called a professional corporation, which can still elect S Corp status, but right now Collective can only support LLCs that elect S Corp status. So Bart, if you've got a professional license, real estate, CPA, attorney, architect, you may be subject to this professional corporation requirement that exists in California, which could be the indicator for the disqualification. We can take your name down. We can put some information in the chat potentially to reach out if you want more. If that's not what's blocking you, we can figure out why. But that is often sometimes a blocker for folks in California. Matt's asking, for a single member LLC, at what income level does it make sense to have an S Corp? You're in California. So we will emphasize, we're looking at profit. So profit after your deductions, it's arbitrary. It depends on your whole tax profile. But if this business is your only source of income, if your profit is over 60,000, it's time to have the conversation about whether or not adding the S Corp election makes sense. Ashley, I submitted my S Corp election, but the IRS hasn't received it. We faxed it twice and are having a meeting with them later today. This is making our taxes unable to be filed properly. Any tips? So Ashley, what I would consider is what was the effective date that you put on your S Corp election? If it was to be effective the 1st of 2025, you don't have anything due yet. So you can maybe sit at ease if it's going to get accepted. Just know that for 2025, your filing requirement isn't until March. So the best thing you can do right now is maybe assume that it will get accepted and then get your compliance pieces in place. So bookkeeping, if you're not doing that already, maybe it's collective, maybe it's something like QuickBooks to maintain profit and loss and balance sheet, and then get a payroll provider. And you can start running payroll for yourself. In the instance that it gets rejected, the IRS will likely tell you why, and you can resubmit the form with your, January 1, 2025 effective date. But if you submitted it and you assume it was filled out properly and you want to be treated as an S Corp for 2025, you don't necessarily need to wait for the IRS to confirm it. You can start operating as an S Corp. Neil, how far into the year can I change to be an S Corp and file taxes for the entire year as an S Corp? So in order for you to be eligible to have a full year, full 12 months from January 1, a legal entity needs to be in place first. So Neil, if you had an LLC that existed prior to 2025, technically you can make a January 1st S Corp election for this year. What you have to consider is the IRS has a timely deadline to make an S Corp election. And then after that date, you would file the election following late relief. So at this point in the year for a 2025 election, it would be considered late. That would have been due March 15th, 2025. But you can follow the late relief process. And so assuming you had an LLC, the door's still open. Similar to the last question, you'll want to get compliance pieces in place. So bookkeeping, payroll, all of which is what Collective does. So if that's you and you're ready to be an S Corp, you're a single owned business owner, feel free to book time with one of our advisors, but there's still time for this year. Jennifer, are there special exceptions to add S Corp status retroactively? That is a great question. I don't know. I'm trying to think of a comparable exception the IRS makes. So expats, for example, if you are a US citizen living outside of the United States, the IRS has exceptions for extended tax filing deadlines. I don't know that exists for the S Corp election. So it's a great question. Let me find out, and we'll try to get back to you on that, Jennifer. Leilani's asking, what if your income is less than 75K? So the IRS doesn't care if you have a loss, $1 million of profit, $2,000 of profit. You can be an S Corp with any amount of business income and profit. If you are looking for a savings opportunity and having less than 75,000 or less than 60,000 of profit, it just may mean that you are paying more for bookkeeping, business tax filing, payroll subscriptions. You may be paying more for all of that than what your savings potential is of the S Corp. So it's not that you can't do it. It's just that maybe you break even in those lower profit years. Jennifer, at what level of revenue or income does an S Corp not make sense? So Jennifer is asking a question on the other end of the spectrum. What if you're a high earner, 500,000, $1 million of profit? There's no rule again. Really what might come into play more when you become a high earner is factoring in the state level S Corp implications. So let's use New York City, for example. They've got a 9% city level tax on S Corp business profit that comes from New York. As you become a higher earner, maybe that state or city level tax obligation outweighs any savings potential. If that's your motivator for being an S Corp, maybe it doesn't make sense when you're a high earner. There are other advantages of being an S Corp, like maybe you just want your business formalized on a separate business tax return. Maybe you want to apply for future grants, so you need tax returns, you need financial statements. Maybe you want that W-2 salary from your business for future proof of income. The retirement matching option, solo 401k is a big deal. Maybe having the S Corp is the means to max out retirement in the way that you want to. So it's not if you talk to accountants and you ask a question, they'll probably say the answer is it depends. It truly does depend where you live, what state, what city, what locality you're in, because the local level fees may start to outweigh any savings advantage. Alana, are taxes due on the owner distribution? Yes. So how does an S Corp tax flow work once you add this S Corp election? Um, when you file an S Corp tax return, it's due every March. It's going to generate two important tax forms. One is your W-2 that shows your salary, the reasonable salary you took out of your business, and you include that on your personal return, just like normal. There's another form called a K-1, which shows the remaining business profit. That K-1 is also included in your personal tax return, just like a W-2 is. So between the two, those two tax forms are how you ultimately report that business income to the IRS, and that's how you pay the taxes on it. So the wage piece, that's the portion of your income that you'll pay income tax and self-employment tax on. The distributions or the remaining business profit is reported on that K-1, and that's only subject to your income tax. So your income tax rate is determined on your filing status, single, married, filing joint, and then your total household income is what ultimately determines your tax rate. And so you'll pay income tax on that owner distribution, which will also include all the remaining business profit that's not your salary. So income tax on owner distribution, income tax, and self-employment on your wage. We've got over 100 folks on. I'm going to keep going. If you're cool to hang on, we'll keep going. We'll do a couple more. There's still 35 open questions, which means I've just been staying at the same because you keep asking great questions. So we'll keep going, and then we'll record the rest of the questions, not live, but after, and we'll post them to YouTube for you to watch. Tanya's asking, what's considered a reasonable salary? Can you give an example? As an S Corp, my past 2 years, I've had more net profit, but this year it's much lower with no revenue than last quarter. So reasonable salary is such a touchy subject with the IRS because the IRS guidance is so vague. The tax code literally just says it needs to be considered reasonable, which leaves a lot open to interpretation. What we have found best is a comparable salary based on your region, maybe your seniority, where you live within the state. Are you in a city or suburbs? A reasonable salary or a comparable salary is the best benchmark to start determining your reasonable salary. So it could depend on, whether you're part-time or full-time, whether you're new to the industry, experience level. And then you want to adjust your salary year to year. So Tanya, maybe in your first 2 years of business, maybe you were full-time, fully committed, you had growth goals, and your salary matched, how you were investing in your business. But maybe this year you've switched to part-time. And so you have the ability to adjust your salary for that. There isn't a blanket rule. There is no magic formula. If you were to Google, you might come across a 60-40 rule, which is not a rule with the IRS, but it's a great rule of thumb where 60% of your business profit is allocated to a reasonable salary. The remaining 40 is potentially, an owner distribution. So some folks like to use that as a benchmark. When I'm looking at reasonable salary, what do I want to consider? What's the risk of setting your salary too low? So we touched on this in an earlier question. If you take an owner distribution, meaning you take money out of the business without a reasonable salary, then in the eyes of the IRS, that could look like tax avoidance because you're not paying into those Social Security and Medicare systems. Similarly, if you set a salary too low, it can also look like tax avoidance. You can't make, $500,000 of profit and pay yourself $1,000 as a reasonable salary. The risk is that the IRS could flag it and decide a salary for you and then assess that Social Security and Medicare tax later. So oftentimes we ask, what's your risk level? It could be, risk aversion. Some folks want to see what they can get away with a lower salary. Comparable salary based on where you live, time commitment, experience level is a great place to start. Vikram, you got to go, but we'll catch the recording. Thank you for joining. Leilani's asking, which states are not S Corp friendly? Right off the bat, New York. Specifically, if you live within the 5 boroughs, New York City, oftentimes states without a state level income tax, Tennessee, maybe Washington, Texas, Florida. Not that those are not S Corp friendly, but sometimes Having an S Corp can trigger a tax that may not otherwise exist because there's no state level income tax at the individual level. So Tennessee is one that I would flag. New York City, specifically, if you're within the 5 boroughs, is another one that I would flag. It's not to say it won't work. It's just there are other taxes to consider that could outweigh the savings advantage. With S Corp, you would need to pay individual income taxes on salary, correct? That wage comes through as a W-2 that you report on your individual tax return, and that's ultimately where you'll pay income tax. I'm gonna go to 45. We've got folks still on, so 2 more minutes, and then we'll do the rest as a recording. We'll post it to YouTube if that sounds good for everyone. Asia, how do you determine what your salary should be? We did touch on this. It's arbitrary. There's no formula. Comparable salary based on where you live, experience level, time commitment are great places to start. Emily's asking, how do taxes work income-wise with the S Corp? So S Corp is considered a pass-through business. You might hear it called flow-through entity, pass-through entity. What that means is there's no federal tax at the business level. Rather, the income passes through pass-through entity to the owners via that W-2, which shows your reasonable salary, and the K-1 that shows your remaining business profit. So at the federal level, when you file an S Corp tax return, for federal purposes, it's kind of informational. It's going to generate the income statement and the K-1 and the W-2, but the individual owners are the ultimate taxpayer at the federal level. At the state level, depending on where you live, you may have a filing requirement to report that business income, and then the states may assess their own S Corp level fees or S Corp level taxes. But generally, an S Corp is a pass-through business, which means the income flows through to the owner's individual federal and state level personal tax returns. All right, last one. What income threshold do you recommend doing an S Corp for New York City? I don't like S Corps for New York City. It's not to say you can't have one, but more often than not, regardless of what you make, that extra almost 9% city level tax alone can negate the savings advantage that would otherwise exist. So lies, I'm not sure. Maybe between 80,000 of profit and 200,000 of profit, you can have a conversation about S Corp, but the main thing I would consider is what am I going to pay to the city level? And is it going to cancel out any savings advantage that I might otherwise get? We're going to end it there. The next question was for Angie. We've got 32 questions left, so we're going to bookmark these and record answers to them. Thank you so much. I can't thank you enough for the participation and the engagement. Sometimes it's crickets on these sessions, so I really appreciate getting to know everyone and hear your questions. There are no bad questions here. We do these webinars twice a month, so they're free. Please register for the next one. There will be an email that will show the recording, and we'll see you next time. Bye.